we'll talk about some of the timeline first then. I guess that would be critical and help us to understand where we're at and what we need to do. So we need to look at a timeline first then. Okay, starting I guess on the left, I guess from June 2023, you have IFRS there, the International Financial Reporting Standard Foundation. The foundation actually has established the IISB. The IISB is the International Sustainability Standard Board. They help to develop and they need help to develop standards, disclosure standards, sustainability disclosure standards. And so it helps company, what they would need to disclose in relation to sustainability. Understanding many of you are accountant, CFO, financial controller. You must be very familiar with IASB, the International Accounting Standard Board, which is also part of IFRS then. The IASB, the International Accounting Standard Board, they have been developing and approving international standards for financial reporting. So this is almost like a mirror of the IASB then. The IASB was formed at I think it's COP26, they actually formed it. It's to really consolidate all the disclosures and information about ESG. I think Dr. Cox will have a slide about the convergence of all these different standards too. So what happened is IASB are actually working on and developing new disclosure standards for ESG in parallel with the standards for financial reporting, and also about mirroring them and linking them together. So that would be critical and very important. That so IISB has published it, the IFRS S1 and S2, which I'm going to talk in very much details for the rest of my presentations. And also, if you look at the timeline, maybe go down. Bottom there, the yellow item there, the IOSCO. The IOSCO is the International Organization of Security Commissions. Basically, the international organizations for the security and future commissions around the world. And the international organizations, they have endorsed and accepted the ISSB standard and encourage all the members, which include the Hong Kong Security and Future Commissions, to implement, the new the ISSB S1 and S2 standard. Then over time, last year, August, there is a cross-agency steering group, which is formed by the Hong Kong SFC and the Hong Kong MA and other institutions, sort of the cross-agency group, to recognize and develop a roadmap of how Hong Kong going to implement the S1 and S2 then. Basically, they have decided on a phased approach. I will talk a little bit more about it then. And by November, generally there is a recommendation from IFRS to have the implementation this year, starting from the 1st of January 2024. But I guess because the Hong Kong Stock Exchange has considered the readiness of issuers in Hong Kong, Hong Kong Stock Exchange has actually decided and pushed the sort of the implementation day to 1st of January 2025 then, for financial year beginning on 1st of January 2025 then. So basically you will need to complete or prepare the material on the first quarters of, if you have a December year end, and the first quarter of 2026, you will need to disclose the informations. Following it, early this year, 2024, the IFRS has published the ISSB adoption guideline, and at the same time, roughly around April this year, Hong Kong Stock Exchange also published a consultation conclusion of how Hong Kong, or for Hong Kong listed company, how they're going to implement the new S1 and S2 standard. Around the same time, actually, the stock exchange in China, the Shenzhen, the Shanghai, and the Beijing Stock Exchange also published the final versions of their sustainability reporting requirements. And they will be effective from 1st of May from the Chinese perspective. But because the implementation day will be effective for the January 2025 financial year begin then. So basically, we are in line with the timing too. The Hong Kong listed company and also the Asia company, they basically have to together to issue their sustainability reports according to the new standard for the financial year end 2025. So basically, first quarters of 2026, then they would need to disclose all these information. So this is I guess, the critical timeline then. So I'm going to talk about the requirement. I guess first from the Hong Kong perspective, the S1 and S2, the new requirement. Actually, going forward, the IISB would probably have the other standard too. There will be a S3, there will be a S4, S5, and continue. So it will be over time. There will be more and more sort of transparency requirement, disclosures of all these informations. Then, so. But first, there was a timeline to implement S1 and S2 for Hong Kong. In Hong Kong, we adopted a phased approach. I'll actually describe that. Not everyone needs to do everything on the first day. I'll talk about these details then. So basically, we would need to incorporate the S1 into the sustainability reporting. Basically, the S1, it's really the reporting principle. It's about the quality of the information, the timing of the information. I'll talk a little bit more about that then too. Basically, very similar that most of you are very familiar with. It's a principle behind, how do you disclose, financial reporting. So incorporating, S1 into the sustainability reporting. Then also incorporating the S2 requirement. The S2 requirement is the requirement related to climate change related risks or climate related risk disclosure. This will be the S2 requirement. I'll explain how it's actually incorporated into the Hong Kong requirement. There are also some reliefs then too. The relief mean that you may not have to do everything, at the same time. In particular, it may incur a lot of costs, or initially you might not have the skill sets. So there are some relief to take some time to implement S1 and S2 completely then. The ESG reporting is actually not new. We actually, I think, have from 2015 or maybe even earlier, I don't remember the exact data, but we have been having the ESG reporting guideline then. It was started with a guide. It's a guideline. People, issuer could voluntarily implement those kinds of informations, but over time it become a comply or explain requirements. And so either you disclose the information required, if not, then you have to explain why you cannot disclose this information, and also when are you going to plan to disclose some of these information. So it's not something new. But then with the new, S1 and S2 requirement, the Hong Kong Stock Exchange has actually updated the ESG reporting code. Of course, they extended the introductions, which include a climate-related disclosure. And there's not much change on the mandatory disclosure, which is Part B, which are disclosure of some of these KPI information. How much electricity do you use, and how much waste do you generate? Some of these mandatory disclosures, some of these policies that are in place, related to labors and things like that too. And Part C, which are some of these complier explains provisions. Some of them, some are already related to climate related information. So they actually move it down into Part D. And also they are incorporating incorporating the requirement of S2 into Part D then. So basically Part D contains most of the requirements of IFRS S2 then. So, basically, the reporting guide is there. You would need to follow the reporting guide to publish the, informations then. Before I carry on then, we move into the details of the disclosures on climate-related disclosures, I want to talk about S1 first then too. Well, S1, it's more a, principles about disclosures of information. So the first thing is, S1 is really the requirement to disclose information about sustainability. Sustainability in terms of governance, sustainability in terms of the environment, sustainability on the social ecology or the social environment too. So it's about risks related to sustainability, but also about opportunities related to some of these sustainability matters. But then you will need to link it to financial information, and how some of these risks and opportunities going to impact your cash flow, and how some of these information is going to impact your financing. Maybe if you continue to be in environmental damage industry, your financing costs will be higher. Your cost of capital will be higher too. And also looking at more from a short terms and mediums and long term perspective too. So you need to disclose how it's going to affect your organizations in short term, medium terms, or long term perspective. So that's the essence of S1 then too. Basically setting that you would need to disclose financial impact related to risk and opportunity on sustainability. The next slide, it's on the principle on S1 then. It's as most of you, as I said, are accountant, you're very, very familiar with the principle on disclosing your financial reporting information. Is really the same thing then. So we always have the the IFRS on the accounting standards and also the principle on how you disclose financial information. The S1 is basically setting the base and also setting the principle on how do you disclose financial information related to sustainability. It's really the same thing, very similar, related to how you disclose, financial reporting information. It's about quality of information, about whether the information is relevant, what the timeliness of these information, whether they're comparable, and all this then too. You can see other principle about reporting and timing of reporting. A reporting entity. Reporting entity is really to what they are trying to do is your reporting of sustainability should be the same as the entity of your financial reporting. So there is a link there. And also on timing on reporting, it's related to same as your disclosure of your financial reporting there, of your annual report then. So the principle is synchronizing your financial reporting with your sustainability reporting. There are other matters related to materiality. When there are decisions on omitting some information, how it's going to impact the decisions of the primary users, how you actually deal with what you report and what not reports, and all these types of things then too. I won't go into the details. So basically there is a set of principle. So the S1 is about the requirement to disclose financial information related to risk and opportunity, or related to sustainability, related to the environment, related to social matters, related to your governance then. And the principle, the S1 lists down the principles on providing or disclosing such information. It's based on transparency, good timeliness, accuracy, and all that then too. So the next slide, I'm going to move on to the S2. This is basically a summary of Part D of the Hong Kong, ESG, Part D of the ESG reporting. Then you can see that they basically the S2. The S2 is actually, they have taken, if some of you knows it, they actually taken from a disclosure standard sort of put together by TCFD, the Task Force on Climate-Related Financial Disclosure. And the IISB adopted the TCFD and consolidated and modified it or revised it and put it out there. Basically, the S2, it's divided up into 4 sections. And then the 4 sections is actually incorporated into the Hong Kong ESG reporting code, which is the Part D. So the S2, it's where you actually put into, all that information set. So it has 4 areas. The first one is really about the governance, who's responsible of oversights of the disclosures, what are the skills in place, and how do you ensure these skills are in place, and also who has the oversights and making sure all these things actually happen then. Then of course you look at the strategy then. The strategy is, as an organization, you maybe want to be carbon neutral, by 2030. So if you want to reach carbon neutral by 2030, what are some of your strategy? But then what are some of, you can see the detail there. There are some of the scenario, that you could try it out, different scenario, how it's going to impact you then. But it's also looking at then your strategy, how it's going to impact you financially, how it's going to impact your cash flow then, how are you going to able to quantify some of these informations then. So it's important to look at what are the strategy, what are how it's going to impact your organization, not only strategically, but also how it's going to impact the organization financially too. Or in order to help to do this, you really need to have a good risk management system. How do you, many of you are also involved in risk management. How do you identify and how do you prioritize the risk then? When we look at risk, we always look at the impact. We also look at the likelihood on, so it's standard. It's standard risk management process then. But the key is to consider how climate change, what are the risks to the organization, and also opportunity to the organization when climates continue to change, then how it's going to affect and impact your organization. So how do you identify the risks and prioritize them? And of course, identify a way of mitigating this risk, and also integrating it into your overall risk management system. Your risk management system may have a very financial focus right now. How some of these risks going to impact the bottom line of an organization. We can look at designs of products. We can look at technology, but of course now we need to incorporate risks related to climate change and into the bigger risk management a process, which is identifying, prioritizing, finding mitigation, but integrating everything into the whole risk management process. The risk management actually circle back then. It helps you to identify what strategy, and you would understand what sort of financial impact will affect your organizations. And the last column, the last pillar would be, the matrix. Then you would need to quantify some of these informations. What are your emission, the scope 1, scope 2, and scope 3 too. The scope 3 is really about your whole chain, then your upstream and your downstream change, then how your scope 3 emissions were related to your supply chain, and your downstream would be related to your customers and things like that. So you need to disclose the emissions related to all these information too. How you link your board of directors and also your senior management, your senior management's remunerations into all that then too. It's important to set targets, and I guess the purpose of this, it's understanding how climate change may impact you, may bring risks to your organization. For example, flooding. You might have a factory because of climate change. There will be serious flooding. It might flood your factory. Then your production stop. Then your inventory get damaged, right? So some of these would be some of the risks then. But it's also risk could be the not physical risk then too. And maybe it may be what we call transition risk then. Change in technology. Then there are new energy, then fossil fuel will be less usage of fossil fuels and all these types of things, and to how it's going to impact your organization too. It might impact your financing too. Bank will be more reluctant to finance organization in fossil fuel business and things like that, because it's a big circle that you have. Climate risk going to affect your organization, but if you are not helping to enhance the environment, then it will just continue to have more impact on the environment then too. So you have to look into all these risks. You need to set target. How you're going to reduce your impact to the environment, and what are your targets to helping the society too, and how you actually monitor the progress of the of all these informations then.
So let's look at how YieldDrive can help everyone calculate these financial values. And the first thing to consider is, why do this? Why calculate the financial impacts of ESG? Well, one is you have to do it, okay? Regulations are increasing. They're becoming more structured, but regulators will require it increasingly. In Europe, there are regulations for investor organizations, asset managers, and for companies, and they more or less complement each other. There's been a lot of voluntary reporting that is changing, okay? All that voluntary reporting is changing into regulations. Secondly, investors. If you're an executive, in the end, just satisfying investors is not going to make you any money. Satisfying regulators is not going to make you money. Your main aim is to make money, to generate a higher asset value for your investors, for your shareholders, to have a stable growth trajectory, and so forth. So investors, if you please them, your equity price is going to go higher. Pension funds, for example, pension funds normally and increasingly invest in the ESG because they need lower risk. They need certain returns to pay out to their constituents, and ESG is shown to generate less volatile operating results. Then investors think global. You know, funds are generally global. They can be local, but also global. Hong Kong, China are increasingly included in ESG funds. And with S1 and S2, that trend of globalized investment in your area is going to increase. The market, first of all, reputation. Okay, there are studies that show that 80% of the market cap of the S&P 500 is based on intangibles. 60% are based on reputation. So if your reputation in ESG is bad, you know, your overall reputation is going to go down. Secondly, leadership. You're competing with other companies. All right. Do you want to look good, or do you want to look like a laggard? Do you want to look like you're performing better? S1 and S2 with the numbers allow you to compare yourself in a more quantitative way with your competitors. And if you have a great reputation, you'll have a higher company value. Finally, internal, and this is not the least important, but actually in the future, the most important. ESG can drive your company's financials very substantially. Very substantially. If you do ESG right, you can have better margins, you can drive your revenues. Most of your financials, if not all of them, are going to benefit. Finally, you want to, if you're in a C-level or IR exec or ESG exec, you want to impress the board. And all the boards I've known, they don't read long reports. Okay, they want 1 or 2 pages, and with S1 and S2 and yield drive data on a page, you can have, okay, ESG has contributed 20 basis points to reducing our cost of equity capital. Now we're paying less in cost of debt. It's contributed so many % to revenues and so forth. That's what the board actually wants to see. And that's why a lot of board members have been really turned off by ESG, because it was never financial. And now it's turning into becoming financial. Briefly, the yield drive, how we operate. On the one end and on the end, all of these financial and benchmark numbers come out. But it's a two-stage kind of process. The one is, the first stage is we use proprietary AI, which we think is ahead of the pack yet, to scrape data from annual reports, from ESG reports, from news, from filings, from studies, categorize it, score it, and make it digestible for part 2, which then uses our proprietary algorithms we developed over a 15-year period to calculate the financial results of ESG. And this whole scheme works point by point according to each of the ESG indicators, which number 120 at present. And we factor in 24 financial performance ratios into our final assessments, because financial performance ratios show the actual results. So we're not divorcing ESG from financial performance, but our whole approach is always ESG and financial performance. Let me just draw 3 conclusions from what I presented. One is, the large and increasingly large ESG market is becoming more financially transparent. It's becoming more financially quantifiable. You can see which companies are doing well and which companies are just talking about what they're doing. Secondly, yield drive in worldwide, and in this case, in our cooperation with Patrick and Moore Hong Kong, already have the technology, the algorithms, the ability to calculate ESG financial data in final terms, in terms that S1 and S2 require. And the third conclusion from all this is that if you want to do it right, you'll work with Patrick and I.